Hi, Tim Bigham for Delta Derivatives, option hedges and edges, powered by the best option scanning tools on the market today, rbtrader.com. And looking at a market that needs a little power to break out to the upside. That 1940 level proved to be formidable resistance on the S&P 500. Above it, 1970, another layer of resistance. So until further notice, I think we'll have trouble breaking out to the upside. I like selling one standard deviation, 1 month out of the money call spreads as kind of a trade structure going forward here, given the fact the VIX is up around that 22 level again. So 20 to 24 is kind of my range for the VIX, with 22 kind of being the pivot point here. But certainly it's all about oil. We saw oil get shellacked yesterday with the Saudis and Iran coming out basically saying, we ain't going to stop pumping, which put a damper on what had been a pretty decent rally in oil. Obviously, oil stocks fell in unison with that news. And I think going forward, the concerns will trickle through the big banks here, who have some, pretty big exposure to some of the smaller oil companies out there. So I think we'll probably range bound here again, 1940 upside, certainly to the downside, 1810, which was kind of that triple bottom that we saw, had better hold. Otherwise, we might be in for a further leg down, which could cause the VIX to spike. So looking at some yield-based ideas, the 10-year yield below 1.7%. We're looking at 1.68 the last I looked. So stocks like Apple yielding over 2% can make a very good argument that Apple may have better credit quality than the U.S. government. So I like selling out of the money put spreads on these higher yielding stocks. Remember, higher yielding stocks have a bigger put premium compared to very similar lower yielding stocks. So you're in essence getting a little bit of that dividend by selling out of the money puts. I like put spreads, obviously, to define my risk. Names like Coca-Cola with over a 3% yield, looking for very high quality, solid cash flow companies. I think going forward, that's the part of market I would want to be in. So until further notice, I think instead of buy the dips that we saw, a little over a year ago, it's sell the rips and selling out of the money call spreads. And if you're looking for a bullish position, look at those high quality, higher yielding stocks that don't have energy exposure, would be kind of the offset. So until next time, this is Tim Bigham. Here's a good trading. Take care.